Hi, Samyukta. We'll just wait
Hi.
for a couple of minutes for some people to join in, and then we'll start.
Sure. Thanks.
Okay, great. Let's start. Okay, so welcome to the ninth episode of the Everlast. This is an initiative by Alserv, a senior assisted living services company based out of Chennai. So this is this is like a series which we started on the 6th of June, which is the first as a Saturday of June, and we have been conducting live sessions every Saturday at 5 p.m. This is an engagement for seniors, for those who are able to. Uh, for those who are not able to be outside like at events, be outside like at programs, be outside to learn something new and to have a discussion. We are trying to bring that live on Facebook for people to have a discussion and give them a food for thought. um, so like in this series, we've had we've had various topics on music, on dance, on food, and we've had and last week we had like a discussion on yoga and on mental like wellness and fitness. And like in this regard of of the most important things, we have to talk about finance. We have to talk about financial planning for elders. um, you know so which is the most which is one of the most important things to have in mind, and to you know to to make sure that we are that we are that all that more like it is important for all the elders to be independent financially and to be completely stable by themselves, and they should be able to plan their and they should be able to plan their life for all their expenses towards their say towards their say like say we can call it like the silver years, in fact. So like it is important for people to plan for their healthcare, for an emergency. It is important to plan say for gifting their grandkids, or for for, or if they want to learn a new sport or a new art form, or for like any form of entertainment for their life. So uh, so so yeah, so to speak more about it, uh, so in our guest list we have Samyukta today, who is from ithought. She is an expert in like financial advisory. So uh, uh, you know so welcome to the show, Samyukta. Thanks a lot for being with us.
Thanks, Atul. It's really good to be here. And I learned about Alserv after you guys got in touch. And it's really great to know the kind of work that you guys are doing with improving seniors' lives. And I
Thank
think the
you.
best part is that you're able to do it right from their home, right?
Absolutely.
Um, and so I look forward to hearing more about that. And I think just by way of introduction, I'm a certified financial planner and I work with a company based in Chennai called ithought. Together, we've helped more than 500 families plan their finances and look at their financial goals and help them achieve these things. So I'm really looking forward to this discussion. If anybody in the audience has any specific questions, you can go ahead and post it, and we'll be happy to get to that during the course of this conversation.
Great. Fantastic. Okay, thanks a lot. So to start like this, like we want to speak about the common misconceptions of, as to how people plan their finances after they like retire. So like a lot of people think that, they have to have their money in FD and not their money in any kind of a debt instrument, or say like in a stock. And a lot of people, they miss to plan they miss to plan for inflation, they miss to and they miss to plan for an emergency, they might or might not take an health insurance, so like we want to hear more about all these topics from you. So like if you can start with say like what is the importance of a like of a say like say so your insurance for say for an example, for a person who's over like 60 years old, how like important is it to have a renewal of their insurance? So like what do you think about that? What would you advise us?
Okay, great. Actually, this is one of so if I were to look at the common misconceptions that seniors have about financial planning, or how they should be structuring their retirement investments as well as expenses. You touched upon a lot of these points already. The first one is basically inflation.
Correct.
You assume that your cost of living is more or less going to be the same throughout your retirement years. But what you don't account for is that in the earlier part, you actually have more time and you have a better well-being or health. So you might want to pursue more things in the first 10 to 15 years of your retirement, and your expenses may actually go up. And also in terms of inflation, you don't think about how much this is going to affect you, right? Because if you are looking at say even 6% inflation, then every 12 to 15 years, your costs are doubling.
That's right.
So if I start today, if my lifestyle expense is maybe 40,000, 50,000, in 15 years, it's going to be 80,000 to 1 lakh. And most of us don't plan for that, right? And I'm talking about the same standard of living. I'm not talking about an increase or something different. And the second aspect is about healthcare. So many people, not just seniors, feel that, I'm in reasonably good health. I take care of my health, I exercise, I eat right, and this is enough. I don't really need to pay for health insurance. But the problem is, like, you don't want to end up in a situation where you're in a hospital and then footing a very large bill, especially if you're not earning, right? When you're retired, this is the last thing that you want to be paying for out of pocket. And there's a very easy way to avoid this if you just choose to opt for a good health insurance policy. I'll also talk a little bit about what qualifies as a good health insurance policy and when you should get into that.
Absolutely.
So ideally, you talked about renewal.
That's right.
Seniors should never miss renewing their policy. It's absolutely non-negotiable, because getting a new policy after you turn 60 is very, very difficult. And insurers also are risk averse, so they don't want to take on people who have pre-existing conditions, or they might charge you a much higher premium.
That's right.
So to avoid these kind of situations, if you're already locked into a policy and you've been renewing with a person or a particular insurer for many years, you would have accrued certain benefits under that policy, and your premiums are not going to be higher, right? But if you start from scratch, like if I forget to renew my premium this year and I have to purchase a new policy, I'm going to start at a much higher premium.
That's right.
So this is the number one thing. In terms of what makes a good policy, you need to look out for a few details. The first is a waiting period. So for somebody who's starting a new policy, the insurer may say for a certain number of months or years, even if you have a bill that you want to settle, I'm not going to pay that. That's a waiting period.
Correct.
Then you have something known as pre-existing conditions. So if you have certain medical conditions that exist at the time of the policy, the insurer may or may not cover those conditions. So you need a policy that ideally covers all your pre-existing conditions. And the younger you are, the more easier it is to get a policy that covers conditions, right? The third element is exclusions. So this is similar to your pre-existing condition, where the insurer will say, for these diseases, I will not settle any claims.
Got it.
So they will just not pay for certain treatments or certain diseases. And the last thing that you really need to look out for is something known as co-payment. So co-payment basically means that if I am hospitalized and my insurance bill is 1 lakh and I have a 3 lakh health insurance cover, my insurer may say that I have to pay 50% of the bill. That's a co-payment.
Okay.
So now they won't be settling 1 lakh even though it's within that limit. They will only pay 50,000 and I will have to pay the remaining 50,000.
Awesome. Got it. Okay. Okay.
Right. So this was the second thing. And I think in terms of investments,
Of course,
there is a lot of, I mean, we'll probably get into more detail.
Yeah. So yeah. So like, if you want to, so like start doing that, yeah. So which instrument do you think is the, the most effective or the basic one which people should have at all times of investment? Is it an FD or is it say like a mutual fund, which has not been, a lot of people have not been investing in a mutual fund, like earlier, maybe like it became more famous or more, like a lot of people have started investing in a mutual fund only over the last 4-5 years or so. So, now do you think is a good time to start for people to like invest in a mutual fund?
Yeah, definitely. So I think the beauty of mutual funds is that most of us think that the only thing that you can do with a mutual fund is to invest in the equity markets. But actually, you can also invest in debt, which is similar to your FDs. You can also even buy gold through a mutual fund. And if you're a senior, you don't want to be holding physical gold that's stored in like a bank locker somewhere where you have to keep going and checking if everything is okay. But at the same time, that security of holding this one asset, which is basically timeless, right? From our grandparents, great grandparents, they've all invested in gold and it's all worked out for them. So I think this is the beauty. You can invest in all of these instruments. It's all digitally stored. It's easy to transfer. If you want to take out money, that's also very easy to do. In fact, I think for your debt mutual funds, which are similar to your FD, you can get that money within 1 working day into your bank account, right?
That's right.
And if you were looking at liquidating something like a property, that could take you like anywhere between 1 year to 18 months or even longer by the time you get a fair price or the right person to sell it to and all the paperwork gets settled. So I think in terms of ease of transaction, mutual funds makes a lot of sense for seniors. And if it was only one investment vehicle that you had to choose, I would say this. But that being said, I think FDs are a great investment for seniors too.
Okay. Of course. Hey, I'm just going to take a step back. There is a question about the previous topic. So this is about, so like, which is more important, life insurance or health insurance?
Okay, I'm glad this came up because one of the things that I really wanted to discuss today was about life insurance for seniors. Now, the number one myth is that you need life insurance through your whole life. And the truth is you don't actually need it. You need it during your working years because what is a life insurance product actually insuring? It's insuring your life in a financial way, right? So it's basically your financial work. And that is maximum when you are working and you are earning. And so during your working years, that's when you need life insurance. So once you retire, the idea is that one, you won't have any loans to settle. So that liability will not fall on your children or your spouse or anybody else in the family. Two, you don't have an income that you're trying to replace for the family, right? And you have assets in your retirement corpus. So even if you're providing for a dependent spouse or a dependent child, there is a flow of income. There are assets that will take care of their needs.
Got it.
So what tends to happen is there's a lot of mis-selling in this industry where Life insurance products are sold to seniors. These can be unit-linked insurance policies. They can be endowment plans. Sometimes they'll also be pension plans, right? Where you get a certain life cover, but you don't need any of these products. You actually only need health insurance. And if you are to choose between the two, you should definitely always prioritize your health insurance over your life insurance. If you have policies that continue for a few years into retirement, it's worth evaluating whether you should continue paying the premiums or what your exit options are. But you should definitely not buy new life insurance products once you retire. Yeah.
Okay, got it. So there is another, say like an important point which you had mentioned, that you should be like able to finish all your loans by the time you plan for your retirement. So that is something, which so some people might miss as well. So like it is important for people to know that they have to end their loans by the time they retire.
Yes. Yes, it is. Absolutely. Because I think if you're retired and you're repaying loans, it can be extremely stressful to meet that EMI payment because you're constantly going to choose between that loan and your lifestyle. So one solution would be to sit down with a financial planner or a professional and evaluate your options. So sometimes that might mean selling an asset so that you can settle the loan. Sometimes that might mean continuing to pay the loan, or you might have to restructure your portfolio and find a way to handle that. But at the end of the day, or the other option would be to work a little bit longer so that you don't have to worry about the income aspect and you're able to sustain paying the loan. So seeing what works best in each case is really important.
Correct.
And there's no like one-off solution. Like you can't read something online and think that that's what is going to work for you. You actually have to sit down and figure out what is best for yourself.
So like it is also like important to have like a financial planner to be able to like advise you what are the right options to have as well.
Right. Because right down to managing your loans or even figuring out, what insurance products you should be looking at or deciding. So if you have your retirement savings, you also need to figure out what is a sustainable amount that you can take out, right? Because like we mentioned earlier, many people don't factor inflation into account when they're looking at their savings, or they may be hesitant towards investing in asset classes like equity because it can go up and down, and this year's returns have not painted a good picture or given any investors confidence to come into the market, right? So these are reasons why you need to talk to a professional, because they can help you make a more holistic decision rather than going with what feels safest, because not everything that we do with the intention of bringing safety actually results in that.
Absolutely, yes. So we have another question here. What about pure pension?
Okay, coming to pensions. So
yes,
see, there is the way a good retirement corpus will have a little bit of everything. So you will have some pension, which is basically fixed income that's coming in. You will have fixed deposits where again you have like a guaranteed return and a stable sort of source of income. But you will also have assets that are meant for growth and beating inflation. So you will have a little bit of equity. And I'll also take this time to look at why you should have debt funds in your portfolio as well.
Yes.
Right? So coming to debt mutual funds, let me look at the pros and cons of having an FD first.
Absolutely, yes.
I will just share my screen.
Okay, great.
Is this visible to everyone?
It should be visible. Yes.
Okay, so coming to the pros and cons of having an FD, like I think to start off with, it's a fantastic investment, right? Because who doesn't want predictability and safety when it comes to an investment? And there's nothing comparable in this market. Like there's nothing else where it's this easy to understand. You know what you're getting into. You know what your rate of interest is. you know when you're entering, you know when you're exiting. So
Correct.
there's nothing as good as an FD out there. And you also get your fixed return. So if I think today, if we look at the FD rates, it's somewhere around 5.6, 5.7% for a 1-year FD with a bank. And you can also choose, like if I take a 3-year FD, do I want to have that income come to me on a year-on-year basis, or do I want to let that accumulate and come to me towards the end?
Correct.
So you can choose between like compound and simple interest with this. And you have many options. So you're not restricted just to a bank FD. There are many corporates that also have fixed deposits. There are non-banking financial companies also that do FDs. So you'll see different rates, and different people have, different entities offer different returns on those fixed deposits. And more importantly, as a senior, you get a special rate, which is typically 0.25% more than what a normal depositor would get. So it is pretty attractive. Like, I wouldn't say that you shouldn't have any FDs in your retirement corpus at all, because you are getting a good deal there. But I think in this whole process, we've simplified that product, and we kind of have overlooked certain risks that are there with FDs as well. So the first is there's a lot of perceived safety because the returns are projected as fixed and guaranteed. But if we really look at what's happening in an FD, when you go to a bank or a company and you're making a fixed deposit investment with them, what you're actually doing is you are lending them money.
Correct.
Okay. So when I'm lending money, that means they are going to repay my principal, and they're also going to give me interest over a period of time. And we all know that lending to one person is different from lending to another person. And that same sort of risk is there when you are looking at banks versus corporates versus the government versus, NBFCs. So, and this risk, this is why there are different rates for an FD. So if I was going to bank A, they might be giving me 5.6%. Whereas if I go to bank B, maybe they're giving me 6%. And if I go to an NBFC, maybe they're giving me 7%. So why are there different rates? This is because there is a higher level of risk associated with somebody who's giving you a higher interest rate. Either they need that, so they're willing to pay a little bit more, or in general, they may not have a very strong balance sheet, and that's why they're willing to pay more for that money. Right? So that risk is there. And I think many investors or savers would be familiar with the fact that DHFL defaulted on their fixed deposits, right? So that can happen. You can lose your money, but until it happens, nobody realizes that this can happen. Right? And that's not the best way to find out also. So the second thing is interest rate risk. This is a bit complicated, so I'll try to explain it as best as I can. But if there are any questions, like, I'll be happy to take them. Let's say you have a 3-year FD today. Okay. The rate might be at 5.8%. And you decide that you're going to lock in at 5.8% today for the next 3 years. Next year, a 2-year FD is at 5.9%. Let's say the interest rates go up. So you miss out on that opportunity because you're already locked in at a lower rate for the next 2 years. 3 years, sorry. And similarly, if at the top of the cycle, if the deposit rates are like, say, 7.5%, but you decide to do a 1-year FD, and the following year the rates come down to 7%, you miss that chance of having a longer investment with a higher interest rate. Is that okay?
I got it. So, like, are you saying, for example, then that should we have a smaller tenure of an FD?
So when interest rates are low, like the present scenario, where I don't think anybody has ever seen 5.5%, 5.6% on an FD, right? We're all mentally tuned to seeing 7% as the return from these instruments. So in such a situation, you definitely don't want to make like a long-term FD, right?
Got it.
Because eventually rates have to come back up. It may take a couple of years, but when it comes back up, you want to have that liquidity to make an investment in a longer term deposit.
Okay, I
And
got it. I
typically
understand.
when the rates go higher, you want to make a long term deposit and not like a 1 year FD.
Got it. Got it. That's right. Okay, so while we are on the topic of investing, so we have a question now. How early should you plan for your retirement, and which instruments do you think that we can have for a long-term saving?
Okay, great. So when it comes to retirement, I think 15
So
years,
perhaps we can start at the, say, when you're 30.
yes. Actually, you can start at any age. You can
Okay.
start at 20 also, right from your first job.
Okay.
In fact, most of us don't realize this, but right from our first jobs, we are actually saving for retirement because you contribute to something known as your provident fund.
That's right.
And that is basically a retirement instrument. So through your life, through different jobs, you will transfer your PF from one company to another, and that's basically a retirement saving. But you can do more than just what's in your provident fund. You can actually do other things, and it's important to do that.
Okay.
The thing is, planning itself changes, like your priorities in planning change over the years. So the earlier you set, so probably in your 20s is when you have maximum flexibility because you may not be married, you may not have kids, you may not have any other financial commitments as such. So you can actually save a lot towards retirement and save to spend for the things that you want to enjoy in those years. By the time you get to your 30s, most people have settled down, they have a family. So the expenses would also be higher at this point. And your priorities in terms of saving might be to support elders in the family or for your children, something along those lines. But you need, like, when you start getting serious about retirement, you need a good 15 years. And the reason I'm saying this is because a market cycle may take like 5 to 7 years, and you can achieve so much in one cycle. Um, and also, in terms of giving your money time to compound, the more time you have, the better off you're going to be. So if you want to retire at 60, you should seriously come up with a retirement plan when in your 40s, right?
Okay. Got it.
Doing it a few years before puts stress, because let's say you have 2, 3 properties which you had originally kept for retirement or something like that. But then you realize that you're not able to lease it out to a tenant, or that it's becoming a hassle to maintain, and maybe you want to shift somewhere to another place for retirement and you don't want this on your head. It's not easy to sell your property the day that you decide to do it. That
Of course,
action
yes.
itself may take a couple of years, and you need to be
Or
patient
maybe
because,
more than that as well.
yeah. So
That's true.
just giving yourself that time and that buffer to take action is really crucial. And you, like with 15 years, you have a good runway to retirement. You're able to make decisions. If you have to undo certain things, you have time. If you have to reprioritize your goals. So I think specifically in the Indian context, right? A lot of us feel very hesitant when we're looking to say something like, I would want to prioritize my retirement over providing for my son or daughter's wedding, or I have to send my children abroad to study. So you let retirement take a backseat, and that may not be the best decision for the family, right?
Got it.
Because you need to look at it beyond just what you feel as your responsibility as a parent. There are certain other aspects also that you need to take into consideration. So for education, you can always get an education loan. For weddings, you have other options. You can choose to downsize, even though that's not, something that you might ideally want to do. But evaluating those options and understanding what is best for you, or at least making an informed decision, like knowing that if I spend X amount on a wedding in the family, would mean that I would lose this income during my retirement, right?
That's right.
So knowing that trade-off, actually seeing it in numbers and then making a decision is better than just going with your emotional feeling of what is right and what is wrong.
That's right. So you had also spoken about, like having a property, like if you can throw some light on, like what do you think about having a property, say to like invest in a house, say like in your 30s or 40s, and if you can throw some light on the concept of reverse mortgage and and like if you can end that with a few words on what you think about a retirement community, and how do you think people should look at it as an option?
Absolutely. So I think buying a house at any age is a big decision,
Hmm.
and it needs to be planned, right? It cannot be a spontaneous decision. I mean, of course, it might feel that way because you might go see a property and then, it looks like the place that you want to live in, and then you decide to buy it. But that's ideally not the best way to do it because um, it's a huge decision, right? Like a
Of
lot of
course,
people in
yes.
their 20s are, I mean, like my friends are thinking like 100 times about getting married to somebody. But like a house, they don't think that much. But like a house is so, it's just as important, right?
That's
And
right.
there's always going to be a loan that comes with it. There's always going to be the upkeep. And it kind of will restrict you. So if you're quite rooted in one city or one place and you're going to live there, then it's okay to make that kind of commitment. But if you're the kind of person who's going to be changing jobs a lot or wants that flexibility, then a house can actually tie you down. And you may not be living in the place that you want to live in, right? Like, what if you have this great house, but you just can't live there because your work is somewhere else? Or
That's right.
so, but I'm not saying don't buy a house. Of course, that is an aspiration. You need to plan for it. But the thing is, what tends to happen is if you buy it a little too early, then you end up paying more on the loan because you're forced, like in the earlier stages of your career, you need a longer loan because you can't afford a very high EMI, right?
That's
And
right.
uh, also what you could be saving is going to the bank. You're basically repaying a loan. And ultimately that you lose time, and really time is the most important element in your investment equation. The more time that you have, the more options that you have, and the more things that you can achieve. So wait until you have a certain level of career stability. um,
Okay.
and when you decide to buy a house, you need to understand that your entire asset allocation is going to get shifted, right? Because of how you can't
Correct.
buy 1 square foot by 1 square foot, right? And you cannot
Correct. You
sell
have to
also
buy
in
a.
that way. Yeah,
That's
you
right.
have to.
That's
It's
right.
a large commitment that you're making upfront. um, so because you're going to be doing that, like plan it, decide, give yourself like again around 5 to 10 years to actually even buy your house. So being patient is going to pay off because while we feel that no, this is the best property and I won't ever get a deal like this again, if you actually spend time talking to people who've bought multiple houses, they will tell you that other opportunities come, right? And especially people who bought and sold houses will tell you that uh, you don't have to rush into anything. Like what you think is really good today will be different 5 years down the line, and it will pay off being patient.
Okay. So like on the same topic, I have another question to like follow that. What is the average kind of a tenure for a housing loan? Um,
Like,
like this is for a house, say for 1,500 square foot house, or or a 1,800 square foot house on a high street in a big city. Uh, so like, what do you think is the average kind of a tenure?
see, like your tenure depends on the person who's borrowing, right?
Okay. Okay.
And it depends on how much you take as a loan. So the maximum you can stretch is to about 30 years. Uh,
Okay.
but ideally, you want to keep your loan within like 15 years. And if you take it at the right point in your career, you can actually close your loan in 10 years or less because you can choose how to deploy your savings and how to basically end up paying more towards the loan.
Okay. So there is another question on the real estate. So this is from so Madhumita. how do you look at youngsters investing in a house as an investment for an income after, like after they like retire? Okay, maybe we, we can talk about the concept of reverse mortgage as well here.
Yeah. So,
Yeah.
okay, so let's talk about reverse mortgage, because I
Mhm.
think, like, although there is some knowledge about this product in the market, I
Of
think
course.
most people have a very surface level understanding of how reverse mortgages work, right? So,
Yes.
in very, very simple terms, it's the opposite of a home loan. And
Okay.
that means basically, I'm just going to share a visual with you guys,
Okay, great.
so that this would be a little easier for people to understand. So coming to a reverse mortgage, what tends to happen in this equation is that you pledge your house to the bank, and the bank basically pays you an EMI for a
Okay.
fixed period of time or through your entire life, depending on what option you choose, right? So if it's through your whole life, it's known as an annuity. Otherwise, it's just a regular reverse mortgage loan. And the key advantage to having a reverse mortgage loan is that you continue to be the owner of the property through your entire life, regardless of whether the mortgage loan payments stop or not. So I think the maximum amount you can have for a loan is 20 years if you choose the mortgage option, but annuity would basically be for life. And that's obviously not predetermined. And since you're the owner, you have to pay for the upkeep, you have to pay for the insurance on your house, and you also will continue to pay property taxes. So all of this is still on you. And um, and basically, the reason why you have to maintain your house is because every few years they'll value your house again to see how much of the loan is applicable, right? Uh, and when they do that revaluing, if your house is not in great condition, it's going to get downgraded. So the income that you get would also reduce. And most people assume that their entire house, like the whole value, is what you'll get as the loan. But from a more practical and real world scenario, it's somewhere between 40 to 60% of your house value. It's never going to be 100%. Uh, and now coming to the reason why we feel that reverse mortgages are not the best option, it's because once you have a reverse mortgage loan, let's talk about what happens to the next generation, right? Now, let's say after your time, what is it that happens to the loan? So your legal heirs can either choose to repay the loan to the bank. So whatever the bank has paid you along with interest, they have to settle, and then they will buy back the house. So the house goes back into their ownership. Alternatively, if your legal heirs don't want the house and they're like, okay, let the bank sell it, uh, that can happen. The bank will sell the house, and whatever gains are made, the tax liability falls on your children or your legal heirs, right? So they are liable for the capital gains. Now, basically,
Hey, there
the
is a
draw,
question here
yeah.
on the reverse mortgage. So, like, is there a clause on how old the house can be for to like avail this option of reverse mortgage?
I don't think there are any clauses, but obviously, the older a building is, uh, the lower your loan amount is going to
Loan
be.
amount is okay.
And
Got it.
depending on the condition of the house, also, it might be lesser.
Got it. Great. Okay. So a person has to like evaluate this with the banker even before they sign up for this.
Right. But
Uh,
actually,
uh,
I think this is a discussion that should be had internally with the family before you meet a banker, because
okay.
the banker is obviously going to be very happy to give you a loan.
Of
But
course, yes.
the reason why I say discuss this with your family is because, see, when you look at ultimately who's going to be settling it, it is going to be your kids or, your family. So you could try to see if there's some sort of informal arrangement that you could um, sort of arrive at with your family, where you're basically looking at settling the house in their name after your time, and they continue to give you some sort of income like the bank would, right? So in this arrangement, the bank doesn't get anything. Everything stays within your family, and I think that's a win-win for both you as well as your children.
Okay. Okay, got it. I understand. Okay, great. Okay, so to like move on to the next topic, so like what do you think about a retirement community, about investing in a retirement community? Say, say for example, like if we have to take like a case study to make this easier, say for a single woman at the age of 62, 63, and she has only one son who lives in like another city and not, so do you think it is wise for her to sell her house and move into a retirement community, or is it better to have the house because it like it might like it might create more value?
Okay, this is actually a really interesting question, and I think we should spend a considerable amount of time talking about this, right?
Absolutely.
Because a retirement community. So, like I said earlier, any house that you buy is a big decision. It doesn't matter whether you're 30, it doesn't matter whether you're 60. It's still a big decision at that point, and
Right.
you want to get it right, or as right as you possibly can. If you have a house that you've lived in for the last 20 years, 30 years, and now you feel you're a little older and you may not be able to manage on your own, then I think it's natural to think about a retirement community. It's not wrong, but especially if your children live away and you don't want to move, or you're happy living where you are. But when you're looking at a retirement community, again, you're looking at moving and sort of upturning your life, right? Uh, I think it would be better to, and obviously you can speak more on this, but it would be better to try living in a retirement community before you buy a house. Because
Okay.
what if you don't fit in? There's a whole
Absolutely
social
right.
element to this, right? What if you don't fit in? What if you don't like the services? And then if you bought the house, you're stuck with it. You can't
Correct. You
decide
can't
to
sell
leave.
the house. Yeah.
Yeah. And also from a perspective of thinking about your children, this is not an asset that you can leave behind for them, right?
Got it.
Uh, what are they going to do with a retirement house?
That's right. Absolutely right.
So, and also like if you want to move in, but I feel like from what you guys have told me about what Alserv does, you kind of take care of this problem of I'm older, I need help, I need someone around, but I'm also in it, like fit enough to go about doing things, to enjoy my life. I like being in my house,
That's
and
right.
even to live in a retirement community, you need a certain level of autonomy. So I don't think it's worth at any point to buy a retirement house, um, because mainly you don't know, like you're going to be looking at living there for 20 plus years, right?
That's right.
uh, and you don't know what the quality of management is going to be 10 years down the line. You don't know whether a better community would come up somewhere else. Your friends might move. So this is kind of like tying you down, but renting it, seeing if it works for you, and then making an informed decision is probably like a better route.
Nice. Thanks. So this is our main kind of a takeaway here, where, we want people to try this out for, say, like 4 to 6 months, and then they can be like open to investing in a house if it works for them. Okay, great. Thanks. Okay, so now I know, like if you have to move on to the next topic, okay, I will just take a question. So like before that, is an ancestral property okay for a reverse mortgage, or does it have to be a self-fund property?
Ancestral property should be fine if it's clearly in one person's
In
name,
one name.
because
Okay.
the bank will not allow anything where there is no clear title, or if there's a possibility of dispute, like they will not give a loan on those properties.
Okay, great. So, okay, so we know of the schemes which are available for seniors by the government. Would you be able to throw some light on that, on what schemes are available, and how can people make use of it optimally?
So I will basically talk about three schemes,
Okay.
but there are a lot more, and I guess
Sure.
we can take questions for the remaining, for whatever else I've not covered. Uh, so,
Absolutely.
so the three schemes that I'm going to be talking about are the Senior Citizen Savings Scheme, which
Yeah.
is SCSS, that's in column
Mhm.
one. Then we have PMVVY, or Pradhan Mantri Vaya Vandana Yojana, which is a pension scheme. And then we have
Okay.
the last one, which is Post Office Monthly Income Scheme, also known as POMIS.
Okay.
So if we look at the Senior Citizen Savings Scheme and the PMVVY, so I'll compare both of these together first because they're similar in a lot of aspects, and
Okay.
and then I'll talk about POMIS separately. So these two are basically exclusively for senior citizens, and the interest rate right now is about 7.4%.
Mhm.
So the PMVVY is a pension. So you go to LIC and you buy. So your minimum investment in both of these schemes is 1,000 rupees, and your maximum is capped at 15 lakhs.
Okay.
Okay. So you can go and purchase an annuity under the PMVVY with, say, LIC, and you can decide at what uh, frequency you want to receive your pension. So you can decide once a year, once a month, whatever it is, you can fix it, and the rate will be fixed. So it will be 7.4% for the entire 10 years that this policy runs. Whereas if you look at the Senior Citizen Savings Scheme, today the rate is at 7.4%. But this rate gets adjusted every quarter according to whatever the prevailing FD rates are. Now, and your Senior Citizen Savings Scheme is like a different kind of FD, but it more or less works in the same structure. And the term of your account is for 5 years, and you can extend it for an additional 3 years. Now,
Okay.
what if you make this investment and for some reason you want to stop it or you want to take your money out? What happens then? So there are exit penalties on both. So in a senior citizen savings scheme, if you take out the money within 1 year of investment, you don't get any interest on the investment. If you take it out within 1 to 2 years, you lose 2% of the interest earned. And if it's between 2 to 5 years, you lose 1.5%. But you can take it out for any reason. So I don't think you have to give any proof to break your senior citizens savings scheme investment. But for Pradhan Mantri Vaya Vandana Yojana, PMVVY, sorry, you need to have a medical reason, or only under certain special circumstances can you take out the money, right? And
Got
they
it.
will pay
Got it.
out 98% of whatever you invested, roughly, right? So they'll give you a surrender value and you will get that almost the whole amount. In terms of tax benefits, whatever income you earn from both, that is the interest from your senior citizen savings scheme, which is paid every quarter. So there you can't decide that you want it every month or once a year. It's fixed. You get it every quarter. In the PMVVY, you can decide, but both of this income is taxable, and it would be taxable as if you had earned a salary, right?
Okay.
But with the SCSS under Section 80C, you up to 1.5 lakhs can be counted as a deduction from your total income. So that's the
Okay.
basic advantage. Now the Post Office Monthly Income Scheme, or POMIS, this is not restricted only to seniors. Pretty much anyone can invest. The minimum investment is 1,500 and the maximum is 4.5 for a single account. And for a joint account, it can be 9 lakhs. But you can't
Okay.
have a single and a joint account, right? Like you can have only either one of them. And then the term again here is 5 years. And if you take out the investment before 1 year, you don't get any interest. If it's between 1 to 3 years, you lose 2%. And if it's more than 3 years and less than 5 years, you lose 1%. You can exit at any point. Again, this is a little more flexible as long as you're willing to pay that penalty. And there's no tax benefit to this. So from a senior's perspective, you can look at the SCSS over the promise simply because of the interest rate. So this is at 6.6%, whereas that is at 7.4%. But if you keep closely watching it, maybe there will be a reversal. And here, the only advantage here is that you get a monthly income, like as the name would suggest. Whereas in the senior citizen savings scheme, it's once in a quarter.
Got it. Got it. Okay. Okay. This is very interesting. Okay. So where all do you think people can learn more about these schemes? Like, is there is there a place like on the web where they'll be able to learn and compare more about this?
So I think the best place would be to look at the post office, like India Post's website, because that's basically taking the information right from the source, and it can't be disputed. Like whatever is on the website is clearly what applies. Whereas other places might be giving you opinions on these. If this is like if you're trying to do it in a DIY way where you're trying to learn, whereas if you actually have an advisor, then it's worth talking to them about your options and looking at which investment would be most suitable for you.
Okay, great. So like it depends on every like individual. So so like if you have to say, like it is important to have a financial planner to be able to advise you to make sure that you have the right kind of investments and to be able to give you all the to be able to give you like the guidance to make sure that that your money is safe.
Yes, because
Great.
I think there is like definitely there's a lot of mis-selling that happens in the market, and even things that we've noticed, right? So we'll see seniors with a lot of life insurance policies who come in and say that I have this, and it's sold as like a pension product or something along those lines. Then we've seen like probably in 2017-18 we saw a lot of elder investors who got into balanced funds, which are a particular category of mutual funds. And at that point, like the marketing was that every month you get 1% tax-free payout.
Okay.
So that was looking at 12%, where your FD rates were like 6.5, 7 in that range. So obviously it looks like a great investment, but then you don't realize that you cannot equate a balance fund to a fixed deposit, because the underlying instruments are so different. Like equity behaves so differently from debt. And part of the reason why they were able to do that 1% payout was because markets were going up, and it works well in like an upward equity market cycle, but not in a downward equity market cycle, and it's not sustainable, right? And many times, like what investors miss out is that payout that you're getting, it's not pure capital appreciation, it's not interest, it's part of your principal that's coming back to you, right? And you don't notice it because the market is moving upwards, but really that's what's happening. And so to avoid these kind of situations, to avoid being missold, or every time a financial product that comes to you, having that support and knowing that, okay, I can reach out to this person, they will tell me what's good for me, or knowing that there's somebody that you can talk to before you make a financial decision is really important, because you may not feel you may not be able to discuss this all the time with your children, right? Like if something comes up, you may not be able to reach them the moment that you have to make a decision, but knowing that there's somebody who's qualified, somebody who's professional, who is looking out for your interests, who can help you, I think that is very helpful.
Okay, so there is a very like interesting, so like a question which you got. What about elders who don't have children? Where does their wealth go? Where does it, so like, what will happen to their house if they have, or what will happen to their money?
Oh, okay. So I'm not an expert on this, so I will do that as a disclaimer right at the beginning. But basically, the way our system functions, so you can, you would still have legal heirs even if you don't have children, right? It can be your brothers, it can be your brother's children, sister's children. If your parents are still alive, then even your parents would be legal heirs.
So this is a will you are saying, right?
No, I'm just saying in general. So if you
In
have
general,
a
okay.
will, if you have a will, it doesn't need to be, your beneficiary doesn't need to be a legal heir. It doesn't have to be someone who's related to you. Right? Like in my will, if I want, I could leave everything to charity.
Okay, got it.
But if I don't write a will, it's not going to go to that charity, even if everyone knows how deeply involved I am with them.
Okay.
Because when you don't have a will, there's something known as intestate succession. So it goes back to what is laid down by law, and succession rules for different religions and different communities is different. So we have Indian Succession Act and we have Hindu Succession Act. There's something separately for Islam and things like that. So you need to, and that's basically out of your control, and it may not be the way that you want it to, and not all of those definitions will fit into your preference of how you distribute your assets. And I think earlier this week you guys had posted a poll on whether you should have whether it's enough to like nominate, or should you also have a will, right?
Yeah, that's right.
This is a very interesting question because it's not an either or the answer. You actually need to have both. And the reason why I say this is because what is a nominee? A nominee, if I nominate my daughter or my son on my investments, that doesn't mean that the investment goes to my son or my daughter and that they can use it. Okay, so when I appoint somebody as a nominee, they act as a trustee. So they're only the caretaker of that investment after my time.
Got it.
So they are not the owners. And if there's a will, so say I nominate my son, but in my will, I write my daughter's name, then in that case, the investment will go to my daughter because a will always supersede a nomination. But if my intent was to give it to my son, then that intent is lost. So you need to keep that in mind when you're writing your will. But the reason, so then what's the point of having a nominee, right? This is the next question that people come up with.
We should come up with, yeah.
Right? So the reason why you should have a nominee for all your assets is because the transfer of the asset from the bank or the financial institution to a custodian, basically to the trustee or the caretaker of your assets, is really smooth if there's a nominee. If there's no nominee, then you have to go get your legal heirship certificate, then you have to go and do all sorts of formal procedures before that transfer happens, right? So nominee is basically to ensure smooth transfer into your family or to somebody that you trust. And your will is to make sure that your assets get distributed the way that you want it to be done.
Got it.
And basically, nominee is a very like piecemeal approach to doing things, right? Because you'll have hundreds of investments. Every time you have a mutual fund investment, you might have somebody that you nominate. So it's kind of all over the place. But your will is like a consolidated thing, and you need you should definitely take legal help when drafting your will. Because there are two aspects to writing a will. So one is like consolidating your assets and deciding how you want to distribute them. That's where like a financial planner can actually help, because they can help you list out all your assets, find the details, find an approximate value, track these investments. And then you have the legal aspect to make sure that your will doesn't get contested in court, that there's no sort of gap or any possibility of a legal dispute after your time.
Okay, got it. Thanks. So like this is really okay. So this gives people a lot of food for thought for them to think about, and for them to go up and to read and to read more about all the schemes, more about FD, more about investments, about health insurance, and of course, like about will. Great. So this whole 1 hour has been really like interesting. So this leaves a lot of points for us to think about and to discuss. So this whole so this session is going to be on our Facebook page, and it will be part of our like YouTube page as well. And we will have a snippet of this so like in our, like in our, like in all our, so like our pages and handles. So thanks a lot, Samyukta, for this session. This has been
Thanks,
really like
Alserv.
interesting. So like before we like end this, if you have any other question, please, please, you, so you can send us that question and we will forward that to Samyukta and we will get you like an answer. And uh, so thanks a lot for joining. For the next week, we have another very like interesting person to speak with us. So this is going to be like Gaurav. He works for like ESPN, and he's going to give us a lot of insights on sports, on and on sporting. Like what is happening like in the so like so like what is happening like in the world of sports now, so like like in the time of COVID, and how it's going to take off after this. And we're also going to talk about sporting analytics, and we are going to so speak a little more about uh, how people can be like engaged by learning something new. So great. So thanks a lot for like being live with us. Bye.
Thank you. Bye.